Good morning, everybody. My name is Dave Finale, and I am the host of Real Estate Talk TGIF, which is a part of the Real Estate Skill Builder group as well as Modern Agent team. I want to thank everybody for coming on. We've got Jay Guttmann today, who is a Northern New Jersey. He's in Northern New Jersey, and of course, I love people from New Jersey because that's where I'm from, right? So we're going to talk about his story. We're going to talk about his 6-point tax strategy and how to really get the stuff together for your tax consultant for this year. 22, because this is being recorded January 6th of 2023. We're going to be right back. We're just going to do a quick promo and we'll get started with some great stuff. Real estate agents, are you looking to acquire clients consistently to grow your business and income for a great lifestyle? Well, this is Dave Finale, and I'm here to bring you the Real Estate Skill Builder broadcast, Real Estate Talk TGIF, brought to you by Real Estate Skill Builder and the Modern Agent team. Hello again, everybody. This is Dave Finale, Real Estate Talk TGIF. This is episode number 239. That's 239, and we've been doing this 236 weeks in a row, and those extra 3 episodes were within those 236 weeks. Jay Guttmann, I want to welcome you to the broadcast. It's an honor to have you here, sir.
Thank you for having me.
I'm so excited. We'll talk about something that a lot of people think is boring, which is taxes, which is CPAs. And I have had the benefit of working with some great CPAs in the past, and also some CPAs didn't have a personality, and some do. And this guy's got huge personality. Where we talk about helping people, and that's his main goal, to help small businesses, real estate agents, real estate organizations, to help them. Jay, I want to welcome you here today. And I have one question before we get into it. And that first question is really simple. What does TGIF stand for?
Thank God it's Friday.
You are so close. You are so close. I just want you to not feel bad because 95% of people do not get the answer correct. Okay. It is, thank God it's Finale.
I like that.
See, there's no question about what's going on.
I should have thought about that. The marketing spin on it. Love it.
Well, I didn't mean it that way in the very beginning, but that's how it worked out. But anyway, Jay, thanks for coming on. You're a certified public accountant. You're a finance wizard. You just have helped so many people in the past with their finances, with their taxes, with different strategies of investment, et cetera, et cetera. But it had to start somewhere, man. So where did you, growing up and becoming an accountant, were there other choices? Were there ups and downs? Tell me about your past and how you got to where we are today.
Perfect. Accounting was always in the mix. When as a kid, I wanted to do Jay's Pizza. I guess I grew up a little bit and decided that, the margins in the food industry, while they're great, maybe wasn't the right pick for me. So I always wanted to be a business owner and understand dollars, money. The backbone of America is small businesses. The 99% of U.S. economy is between $1 and $50 million businesses. So my firm and I, we specialize in companies and either individuals or big businesses between $1 and $250 million. So we really cover 99.99% of the U.S. business environment. So out of college, I started with the largest CPA firm in the world and worked with some amazing people, advising large multi-billion-dollar companies. It was great, but I did my time there and it got a little old, and I wasn't making the impact that I wanted to. So over 10 years ago, an opportunity arose to work with some of the smartest CPAs that I've ever met and go from the largest CPA to a small boutique CPA firm. And that is now my firm, SRG Advisors, where I am currently co-managing partner. My team and I, we work on high net worth individuals, business owners, real estate agents and salespeople, and many real estate owners, where we could truly advise, consult, and work with our clients on a sometimes day-to-day basis, sometimes maybe on a yearly basis. But the key is to be available to our clients and make sure that we're giving them the proper consulting that they might need. Just as what I do currently now is that there's not, you said you worked with a great CPA. A lot of times I take all the sales calls for my firm right now. And the number one reason clients, prospects give me of why they're changing or they're finding a new CPA is either A, their CPA is retiring, or B, their CPA is not available. They try to get in touch with them, they can't, they call, they email, and they don't get an answer, which to me is one of the easiest things to do. A client calls and, they either book a call on my Calendly link, but that's where we come in and that's where we shine, where we could truly advise and give the client straight, practical answers. And that's what we do on a day-to-day basis.
So so we're talking about working with people setting up their businesses, people building their businesses, et cetera, et cetera. So there has to be some things that people can do. Let's start from the nitty gritty first, right? So when someone's going to set up their business, I mean, is it important for them to be? I mean, these may sound like stupid questions, but these are things that we all think about, right? Should it be an LLC? Should it be an individual? Now, in the state of New Jersey, when it comes to real estate agents, and this is not all over the country, Jay, we can only be paid as individuals. The great state of New Jersey has decided that, yes, they want to pay LLCs, but it's going to take another 2 years to get through all their committees and bullshit that this state has to go through, because let's face it, politics in this state sucks just like most states. But anyway, so a lot of teams in New Jersey, real estate teams, are taking all of the money they get and transferring it to their LLC and building a business and running a business that way. So I know I threw a lot of stuff at you just there. So give me some guidance as to what we do there.
Perfect. So, entity selection is always key to the tax strategy. If you're starting off and you have questions, I would tell you to call up a CPA, start working early on, because entity selection could save thousands, hundreds of thousands, millions of dollars properly picking. I mean, most people, I think, in the real estate salesperson, they get their license, they're paid personally, and they operate as a sole proprietor, where
right.
They just, they get paid individually, which is required by, pretty much New Jersey law in many states. And then they report their information on their personal tax return as a subschedule saying, I'm in business for myself, I make money commissions, and here are my expenses, whatever it is. That's the basic form of business. Then, of course, there's LLC, which is a legal structure. It's not a tax structure, it's a legal structure. So the way it works is that if you're 100% owned LLC, it's called a disregarded entity in the eyes of the tax and IRS world, which means it exists legally, but it doesn't exist for tax purposes. Okay. And that's why a lot of people might do an LLC, just because, they think it might have some legal protection. But on the tax end, you're going to pay the same taxes, whether you're an LLC or a sole proprietor not having the fancy LLC name. I tell a lot of clients, it's a personality trait. Do you want an LLC or not? Do you want to give your personal name and social security number to a bunch of companies that might be paying you versus, just give them an LLC name, which sounds fancier. Having the checks written out to that entity sounds fancier. But in the state of New Jersey, for real estate people, from my understanding, they can't do that anyways. And then the third thing is an entity selection called S Corp, which has, the largest growing entity in the tax environment in business in US is an S Corp. But real estate people who can't be paid into an S Corp, it makes a problem because they can't elect S Corp as a real estate salesperson, because the way tax law works is that wherever the check is written is where you declare the income. So with the salesperson, you're getting that check personally. You can't then just transfer it into a S Corp to save on taxes that many businesses typically do.
So how do you? Okay, so there's teams and there's organizations in this business in the state of New Jersey where they have teams, right? So how does a real estate team in the state of New Jersey, run a business?
So it really depends, I think, if they're a broker or a real estate team.
Right.
So the brokers are able to elect S Corp because they get the license within the S Corp or entity. It's not them operating as their name, they're operating as a business entity. So that's typically allowed. But the teams usually are, independent 1099 contractors where they get their commission, they take it personally, and then they are operating a small book of business as a, small sole proprietor, and then they could either pay their commissions or have people on payroll, but they're not able to do other types of creative tax strategies like other businesses, but they're operating as a small business, just like any small business, but limited due to New Jersey's state laws.
Okay, so now we got structure straightened out as far as what agents are going to do with teams and brokerages, and that's really cool. Thank you for that. So let's go to what are the important things that a real estate agent needs to do on a regular basis to make sure that they're in compliance, et cetera, because compliance is huge in the real estate industry when it comes to taxes and tax strategy. What is important for them to run their business?
Perfect. So, I mean, the number one tax strategy, I have every client in every industry always asking me, Jay, I want to save a ton of money. I'm like, and I tell clients is to keep clean and organized books. We want to know what your income statement is. And typically on a real estate salesperson, they'll have, a 1099 from possibly one brokerage. And that's great. But what about all their expenses that they might have that they should be able to deduct? That's the key. I can't remember what I ate yesterday for lunch, let alone what I need to expense on my business last January. It's a year ago. So typically we send our clients, a simple Excel. It's about 15 lines. It's by month. And we call it a Schedule C tracker. In the IRS and in the tax world, Schedule C equals small business. And each real estate salesperson or agent is running a small business. And if they keep track of their expenses by high-level category on one Excel, then at year end, you could send it to your tax advisor. First off, you know what your net income is. So you could kind of maybe calculate what your tax liability could be, but you also know how much you're making and how much you're spending. And every business owner should understand how much they're making and how much they're spending. Maybe they're going out to meals, their auto expense. Maybe they're spending a lot in supplies or advertising themselves, which should be tracked. And you should know what your net income is per month. Another key besides, keeping track of your books is I tell clients to have a possibly business bank account. So it's disaggregated. It's away from your personal. So you're not mixing personal and business. And another key thing is having one credit card for business. It's the credit card that when you think you have a business expense, you take out at the point of sale and use at the point of sale. Because if you have to go through your personal credit card and start picking out what your business expenses are, it's going to take a lot of time. You're not going to do it. And at year end, you're going to forget about it. But on if you have a place, you run your report for that one credit card and it has all your business expenses by category, you could easily add it to your books on a monthly basis.
Jay, this tax tracker you're talking, are you willing to share that with listeners today?
Sure. Yeah.
They just email. I was thinking maybe they could just email you and ask for it. Would that be okay?
That would be perfect. Yes. Shoot me an email and I will send out this basic Excel. Every sales call I do, I tell them, how do you keep track of your books? And they're like, oh, I don't, or whatever. I'm like, here's an Excel. Utilize it, whether we work together or not. It can only help you, your business, and you to grow. Because without it, I don't want to be pulling teeth from a client being like, how much did you make? What's your expenses? I tell clients, I don't want to know that you went to Home Depot and spent $50 in February. I want to know at year end that you spent $1,222 for repairs and maintenance. And that's what I need. And you, as a client, could keep track of it.
So we just got on the board of, you see, this is for tax tracker, email jay@srgadvisors.com with the subject line tracker, and Jay will send you that tax tracker. And honestly, Jay, you sent this to me a few months ago. I am using it religiously now because it's allowed me to be a lot more organized in what I'm doing with my credit cards, etc. It's basically a chart of accounts, guys. I know it's a fancy phrase, but it's really not. It's what you need to do.
It's so simple.
Right. It really is. It really is. I mean, let's talk about receipts, Jay. Are receipts important to keep? I mean, so you've got a credit card, which now, even though they're wrong and it sucks the way they categorize stuff, and you can also change the categories when you download the Excel spreadsheet. Believe me, I know I'm doing it. What do you still need receipts if you've got the credit card bill?
Yes. From my understanding, a credit card bill is not a receipt of support. It shows that money went out, but it is not a legit support for an agent. Have I seen agents go into it? I mean, they're going to be selecting certain items anyways. The smaller ones, they don't really care. There are IRS limits of like, you don't have to keep receipts for anything above XYZ amount. I'm not exactly sure what it is, but it is a certain amount. But the larger items, technically there should be an invoice and a type of receipt. The idea of printing it and throwing it into a shoebox is long gone. A lot of people, they'll either upload it to if they use a QuickBooks or they use some type of share drive, they'll probably keep a lot of receipts there or in their email.
But Jay, you want me to take the receipts I use on a business trip or receipts I use on a monthly basis and scan them into a system? It doesn't take a lot of time?
So it does take a ton of time. And I would say, I don't know how many clients actually do that, but I do advise them and I tell them, everyone's risk factor is different. Technically, you have to support that it is an ordinary and legit expense for your business. And how would you do that with just a credit card? You can't. So sometimes I tell them, here, throw it into a shoebox. Not that hopefully you'll ever have to open up that shoebox again, but it's there. So if you ever needed to, you could find it. Versus, it is like I have a few clients who are meticulous. They make themselves maybe go crazy on every tiny little thing. But other clients, they also base it on materiality. Be like, I'm going to keep a certain amount above the IRS limits that I need and try to stay as organized as possible. As a CPA, I just take that Schedule C tracker and take those numbers off. I'm not an IRS agent. If I see a number that's aggressive or too high, I say something to the client, not because I'm questioning them whether it was a legit expense or not. I'm just looking out for them for red flags, being like, you made $200,000 and you put auto expense of $170,000. I mean, are we okay with that? I think that's a little aggressive. So that's where I'm coming into play to protect my clients. Rather than be, oh, do you have that receipt? I expect them to keep some type of support in their files. I don't want it. I don't want the shoebox. But if it ever comes down to it, they can supply or come up with that shoebox of receipts.
Okay, great. So the next step is they've got their shoebox of receipts. They've got their tax tracker, which they've put together what everything is, and they've labeled it through the chart of accounts, and they've totaled up office expenses, repairs, supplies. They've totaled that all up and they send this over to you, right? But what they're sending you is, tell me what they need to send you. What, as someone that's going to do the tax return for a real estate agent, what information do you need and what's the maximum or minimum that you need?
So I need that Schedule C tracker. I need a income statement. The main number here is net income. How much are you going to be reporting on your tax return to the IRS? Not gross income, not what you collected, but after all your expenses. And expenses, there are other type of expenses that clients might not realize that they should be added to their Schedule C tracker or the business. Everyone has a cell phone. Right. The question is, how much are you going to be expensing on your business? The answer sometimes not 100% unless it's a full use business cell phone. But there is a percentage to come up with, like, okay, there is a personal piece as well as a business piece. Everyone's got a cell phone and you're taking those calls for both business and personal. Same with auto. There is a percentage for personal use and business use. So there's a lot of things that I want from a client, but for the most part, it's starting off with that Schedule C tracker to give me your starting point of what your net income is. So then I could look at it and be like, oh, I feel like you're missing X, Y, and Z, which is what I typically see as expenses for real estate salespeople. And, sometimes a client will be like, oh, I don't feel comfortable doing that. And I'm like, okay, not a problem. I just want to let you know that's typical for your industry. I actually have one client who doesn't deduct any expenses, and they legit have expenses. I call them crazy 5 times a year, and we file with 0 expenses. And I know that person is paying the government above and beyond what they should be paying. Our idea and why, clients come to us is we want them to pay the least amount of taxes possible by law. I want them to save. And every dollar that you don't put onto that Schedule C tracker or keep track of your expenses, tax rates go up to federally 36, 37%. New Jersey, if you're in the top bracket, almost 10%. I mean, we're talking between 40 and 50% of every dollar that you don't put as an expense is what you're going to be paying in additional taxes. So you don't want to be aggressive, but you don't want to be 0.
Right. I get that 100%. So, all right. So they're giving you the tracker, they're giving you the income statements, they're giving you 1099s, W-2s, et cetera, et cetera. So is there a tax strategy that you would use for real estate agents that, like, are there borderline things that you can deduct and non-borderline things you shouldn't deduct? And are there red flags? What is the IRS looking for? Is anything like, is it going to shoot out when it says, oh no, he, paid $8.99 to have his toenails done and he got that as an expense? Talk to me about that.
So, I mean, a lot of times I see on real estate people, they're like, oh, uniforms. And I'm like, what's your uniform? And I'm like, oh, a custom suit. That doesn't count. That is not an expense for any business unless it can't be worn outside in like day-to-day activity. Like you actually have a real uniform. That could be a business expense. But suits, everyone needs to wear. I mean, I don't wear suits, but everyone can wear a suit outside of the office. It is not a requirement. So there are things that are risky. Uniforms, certain meals and entertainment, like there is no entertainment anymore pretty much for federal. It's just meals and the rules change. But is it that meal ordinary in the course of normal business? So those are things. I mean, when I look at a lot of new clients and I look at their business schedule C on their tax return, and I see every number being even. Advertising, 1,000. Auto, 4,000. I mean, I know that those numbers are pretty much high-level estimates and made up. It's every number being even to the rounded to the nearest thousand. I typically will go back to the client and be like, I don't need an exact number to the dollar. I mean, like, a dollar is great and all, but like I need an actual number to put on a tax return. You can't just throw 1,000 as expenses. So that's typically what I see. There are some things, people are aggressive on, like if they do an auto or a business auto, which I mean, maybe we'll talk later on one of my tax tidbits to discuss the auto. But, a lot of real estate agents and brokers, whatever they're doing, they're driving a lot. So their auto expense should be pretty high. And Same with home office. Home office back in the day got a bad rep. Pre-internet, what were you doing at home? Making some calls on a landline. Now with the internet, home office, most clients do take a home office because they are working from home if they are doing small business like many real estate agents are.
So let's talk about home office then. So let's talk about me. I have an office in my house. I spend most of my time there. Like if I'm in, let's talk about 24 hours. If I'm in my house, I'm in my office 12 hours a day, 7 days a week. Doesn't that mean that I'm there 50% of the time? I could be able to take 50% of my expenses in my house off?
I wish, and that would be great because you'd save a lot of money. But the rules typically are by the square footage. So, what square footage of your office, total of the house, and is it a designated office space? A lot of people, back in the day, it's like, well, is there a bed in that room? Is it really a second bedroom that you converted to work on? And typically, if an agent shows up and knocks on your door, which I have not seen happen, but you never know, the IRS is getting a ton more, billions of dollars more, and they're hiring 87,000 agents. So I don't know if an agent's going to actually show up, but the idea is it needs to be a designated workspace. I don't see a bed behind you, which is a second bedroom. It's a legit office space. So the square footage, divide, over the whole house. And then you can take a percentage of your real estate taxes, your, not the principal of your house, but, the utility bill. There are a lot of expenses that you can now, and typically home office varies, but like you're not going to get to 50%.
Okay. All right, cool. All right. So look, all right. So we've talked about the basics that what an agent needs. And this is really basically, Jay, correct me if I'm wrong, but this is also for small businesses as well. Same kind of thing, because a real estate agent, let's face it, is a small business. I would hope that most agents would understand that, but most agents don't. They think it's a small hobby. Talk to me about the difference between, having a lot of expenses and never having any income when it comes to your real estate business.
Correct. So I've seen it a few times where the IRS, it's kind of like I don't know if it's a rule or an unspoken rule, but after 2 years of losses on a business where you've now taken losses and wrote off against your other income. So let's say you didn't have any income as a real estate person, but you have yearly expenses. After 2 years, the third year, the IRS decides that you're no longer a business, possibly you're a hobby. They use this idea of like, you enjoy like paper planes. Like, let's say you decide to write off all the supplies of making paper planes, and you think you're going to sell it. So in year one, you have $1,000, $5,000 worth of, expenses. Year two, the same. And if you have no income in year three, you're in a loss again. They say that you're not in business of making planes and, paper planes. You have a hobby. You like doing it, but it's not a business that they want you or are able to take those losses against your other income.
Right.
Maybe you have a spouse or some other investment income or whatever's coming in to your personal tax return. They don't want to subsidize your business. And it's not like Amazon, where you have a business plan. Technically, there are many businesses that have losses for the first couple of years. They're in development mode. So there is a line between, okay, what is a hobby? And you actually have a business plan, you have some sales, and you're working on becoming profitable. But a business typically is to become profitable. The IRS wants tax income. They don't want to subsidize your dabbling in a lost business that really you just enjoy doing, but is not a for-profit entity.
Great. All right. So look, we've talked about that. That was something that's really important because I know a lot of agents, one of the things that's really funny to me is, people say, well, I can expense that. Yeah, you can also expense yourself right into bankruptcy. It's really easy to do. You can do that. So everybody needs to watch what they're doing when they're making expenses. A lot of people are going to go out, they'll start in a business and, they want to be important. So they want to look important. So they get a couple of checks and all of a sudden they're renting that, that 5 Series BMW or whatever it is. I see that so often. Actually, I'm not a fan of that style of car simply because I see so many of them, right? Especially in my business. So Jay, let's get down to the nitty gritty, right? Let's get what we tell everybody we're going to talk about today. Your 6 points. Talk to me about this process that you have about helping people as a CPA.
Perfect. So, the first one we already discussed, which is keeping track of your books, clean and organized books. It's making sure one business bank account, one credit card, unless your business is growing. There comes a point in time where you graduate out of that Excel, that Schedule C tracker, and you do have to use an accounting program like QuickBooks or whatever other accounting programs. Those are larger businesses, but you want to graduate out of that Excel. I had one client who took like this financial advisory bookkeeping training consultant program, and they told him to open up 6 bank accounts. To keep track of 6 bank accounts, some of our largest businesses were, doing $250 million of revenue a year don't have 6 bank accounts. Keep it simple. The number 2, I guess, tax tip is, working with the right tax consultant. Your tax consultant becomes your financial quarterback. We're the day-to-day person or monthly person who you're going to call because you have a CPA behind you. We're looking out for retirement. If we don't see retirement in your personal return or anywhere, we're going to ask about it. Why pay the IRS if you could fund your retirement account and it could lower your tax bill? Same with tax planning and strategy. That's what we're doing. And when you're simple and you're just a W-2, sure, I tell clients do it yourself. Don't hire a CPA. A monkey could do it. The TurboTax commercial was like all people are tax people. In my mind, that's just bad marketing and completely false. You need a professional. Just like you go to the doctor and you don't go to WebMD. Same with your taxes. And your taxes are your number 1 largest expense a year. Even your house is sometimes usually cheaper than your taxes on a yearly basis. It's people's largest expense. And you want to make sure you're working with the right tax professional. I've taken on new clients from either doing it themselves or a lot of times, sometimes a prior CPA who didn't specialize in real estate or that certain business. I've gone back. The statute of limitations allows 3 years to go back. And we went back and amended for a client and got them back from the government $1 million because the prior person was not an expert in their field and completed the returns and missed something. And that's a lot of money. Like when I review a prior year tax return and $1 million came back to that client. They were ecstatic. They're still a client to now. They sold the business. I still have them as a personal return and side businesses.
Right.
Number 3, don't complicate your tax life until you're making significant money and your CPA tells you to do something. I see a lot of times where people just read online, some type of forum or something, and they're like, oh, I'm going to jump into an S Corp or a C Corp. And maybe that's a good idea for certain businesses, but not for you. Everyone's tax situation is different. And having a CPA to guide you and tell you, I tell clients, keep things simple until I tell you to complicate your life. Because as a CPA, I'm playing the percentage spread game. If I could save you 3%, that's a lot of money. But if you're only making 100K, 3%, it's good. But, you're going to be paying that in fees to a payroll company and multiple other professionals to save that 3K. But for every 100K you make above, 3% of net profit and your business growing. So 3, 4, 5, 600, let's say you're making $1 million. 3% is a lot of bigger number to make sure that, of course, you'll want to complicate your life and you'll jump through whatever hoops your CPA tells you to do to save that type of money.
Right.
Number 4, you touched on it. You saw the BMWs. I mean, I tell clients, yes, you can buy that. And I typically see it's a big, large Range Rover,
Right.
Whether it's a BMW or not. And the reason behind that is because the IRS rules are written a long time ago of if the car itself is over 6,000 pounds and used 100% for business, you could write that car off in 1 year. So let's say you have a great year. Net income is you've closed a lot of deals and you go out and buy that $100,000 Range Rover and it's over 6,000 pounds and it's used 100% for business. You could write that off. Let's say you made $500,000 that year. Now your tax bill on net income is only going to be taxed on 400K of income because you're writing that car off in 1 year. It's time value of money, but I'd rather pay the IRS 5 years from now than today in the current term. There's a great video of Grant Cardone. He says that like he had this huge tax bill and, he called up, I think it was Boeing, and he wanted to buy like a couple of $1 million jet before year end. He was planning. He knew he was going to have a huge tax bill. And same idea as someone driving the Range Rover, he bought a jet, which negated his tax bill. It's all about proper tax planning. When you make money, either you're going to give it to the IRS and split it with them or come up with proper planning and keep it as long as you can. Number 5 is the magic of being a real estate professional. A lot of real estate agents, they start dabbling in real estate or maybe ownership. So they start cherry picking deals. So let's say they're in their commercial real estate broker or agent and they see a deal that they want, they buy it. But, in the eyes of the US government, if you're a real estate professional, now you could start taking real estate losses against your commission income if you materially participate. So I see a lot of clients now who not only do they have, they're a salesperson or an agent, but they start owning the real estate as well, which is a totally different way. Like I don't talk politics, but, everyone looked at Trump's tax return and was like, oh my gosh, he didn't pay taxes. I looked at it. I'm like, that is normal for a real estate professional. This is the way the tax code has been written. And this is why everyone in the real estate world does it. You see generational wealth. It's typically a lot of times in real estate. The US tax code is written for real estate professionals. Trump didn't pay taxes. A lot of our clients who are dabbling or materially participating in real estate and own buildings, their tax bills are a lot lower than other people's because that's the way the laws are written.
Right. And there's nothing wrong with not paying any taxes. They're just using the laws to their advantage, right? Okay, that's 5. Next.
Let's go.
We got
number 5.
7. What do we have? How many we got?
Well, I think we're at number 5. So we're at number 6 now. This is a simple one. Review your own tax return. Like even when you're working with a CPA, I tell clients, me and you are going to be the number 1 and number 2 of anybody in the world who knows your finances. You're not going to go and rave on Facebook and post your tax return being like, I have the greatest CPA. Look what he did for me. It's a private document. But if I'm the one preparing it, I want a client to take a look at it and be like, does it smell right to you? I know I'm doing my job, but they might have forgotten to tell me something. A lot of clients, especially around the tax deadline, they'll just sign it and send it back to us to e-file. And I'm like, that was too short. Did you actually look at it and review it the way you should review any important document?
Right.
And the last one, number 7, which I came up with today, don't call a CPA, now, January 6th to come on board. Proper planning. Call them in November, December, January, before tax season. We close up new client intake in a few weeks. I'm not picking up a client on March 1st when their business returns are due March 15th. A lot of people don't realize that. They missed the business tax deadline. But I'm not picking up a client on March 1st to get done in 15 days. It's just not possible. I respect the clients who are properly planning, who either A, they know they need a higher CPA, they give a call during either the summer or, down season, not being like, oh, here's a rush order to get done. I want to work with clients who are proactive, planning with us so I can plan for you.
Right.
So that would be one. Is like, waking up in a month from now, I mean, just to get a CPA on the line is going to be tougher. I mean, as I said, there's a statistic saying that 75% of CPAs are retiring in the next 10 years. That statistic was 10 years old already. So there's just a lot less tax professionals and advisors, and especially good ones, to help clients out. Make sure you help them out. Everyone knows tax season or busy season. We do a lot of our work between January and April 15th. We work, everyone thinks I'm on the beach for the summer, and I hope to be, but all our high net worth individuals go on extension, which means, April 15th is a fake deadline. You have to pay in your taxes, but once you pay in your taxes, you could press an extension button. And I tell clients I'm a lot more creative. I can do a lot more, and I make sure your return's 110% in the summer. Then rush it, order out by April 15th, because the IRS has a fake gun to my head. I'd rather properly do things right, make sure the client's perfect, than rush it out and be like, oh, and I have a lot of clients, I've never filed an extension before. We don't charge extra for extension, just make sure that we have enough time instead of condensing all the returns, because every return comes in between February 15th and April 15th. It's a condensed season. There's no reason not to file an extension and get your stuff done right. And also be creative as possible. I'm not looking at a return on April 14th and being like, oh, you didn't give me any XYZ expenses. You forgot to add those to your Schedule C tracker. At that point, it's, either A, will extend and you can give me that information and I'll ask you, I noticed you forgot telephone, auto, meals, advertising. I noticed you had advertising of $5,000 last year. There's nothing this year? Oh, I totally forgot. Those questions are not going to come on April 14th when the deadline's the next day.
Right. And it's actually your job to make sure that they did it right as much as it is their job to make sure you did it right. That makes sense?
Correct.
All right. So let's review these. We've got Jay's points, right? Jay's points. Number one, have a tax strategy, clean and organized records. Number two, work with a real tax consultant. I mean, planning a strategy is important. Number three, don't complicate things. Let me know if I got this right. Don't complicate things unless you're making a lot of money. Keep it simple, right?
Correct.
Don't buy that Range Rover unless you can afford it and you know what you're going to be able to do with it in a tax strategy. Number five, the magic of being a real estate pro as an real estate investor. One thing you can do is you start making good dollars. Number six, actually look at your own tax return and review it, as we've just been saying. And lastly, you know what? You got to plan just as much. You got to plan your chart of accounts. You got to plan who you're going to work with, and don't call them today. Don't call them in January. Don't call them in March. You need to plan for this. So please do it before. Let's be nice. Do it before November. Do it during the year. Have that meeting with your tax strategist, your certified public accountant. Sit with them. Talk about different things that you want to do, what you want to accomplish. Whether they're a financial planner or not, it doesn't matter. They're going to talk to you about the tax things you've got to worry about and you've got to plan for. Does that all make sense, Jay?
Sounds exactly spot on.
Awesome. Hey, man, what would you like to offer out to the real estate community, mortgage professionals, et cetera, that will either watch this live or will see this in a replay?
So offer out, I mean, as I said, give your CPA a call. I always tell clients, the days of me always reaching out on a consistent basis as a CPA, trolling our clients, unless I'm doing your books, which, I tell clients it's expensive to hire your CPA to do your books, but a lot of our clients have that discretionary income and want it done right, and they hire us to do their books. So unless I'm in your books on a monthly basis, I'm not going to call you and be like, oh, I just saw something, because I don't have your books. That Schedule C tracker is with you.
Right.
I might only see that Schedule C tracker on a yearly basis. But let's say hypothetically, you want to be proactive and send it to me in June or July and review it and have that consulting call. It can't hurt. It could only help you to ask all those questions. Can I expense this? Can I not? Should I be doing this? Should I not? I tell clients, call me before you do anything. Why? I can't change it after the fact. You've already done it. I had one client, this is a little more complex on tax strategy, but the client thought they did a 1031 exchange, which I don't know if in the real estate world that many people do know about it. It's exchanging one building for another building tax-free. on the ownership cycle. Maybe some salespeople don't know about it, but like there are a lot of rules to make sure you do a 1031. So at year end, the client told me I did a 1031 this year, and I'm like, oh great, like you didn't tell me, you didn't call me in June, but like, that's possible. Send me all the paperwork, and the qualified intermediary that you did. The idea about 1031 is you can't touch the money. You're not allowed to sell the building, take the money, and then go buy a new building. You got to sell the building. The money's got to go to a third party to hold on for you. And then you could buy a new building with that money. This client didn't use a QI. A 5-minute call with me would have saved this client hundreds of thousands of dollars because it was a fully blown up 1031 that didn't exist. The client ended up paying significant taxes because I don't know who their advisors were. We're usually their financial quarterback, the first person they call. And I could refer you to the real estate agent you need, the lawyer you need, the financial planner, the financial advisor. My Rolodex, I don't actually have one, but of people, ones I trust, ones that I deal with on a consistent basis. That's what I tell clients they should have. They should be reaching out to their CPA to discuss those type of things.
That's really cool, man. Look, I want to thank you so much for being on this broadcast today. I mean, we've got a lot of great tax information, accounting information, even bookkeeping information, right? So look, guys, so I've got your tax tracker on, email you and put tracker in it. I want to put one other thing else up, and there it is. That's your Instagram.
Perfect.
You got your phone number there, your email address. Just one last question before we get to the last thing. There's two more things. One is, how can I, Dave Finale, help you grow your business, Jay?
I mean, exactly what you're doing right now. It's getting the word out. What I've realized is that the more people know what I do and what I do things a little different than possibly the rest, the more people that will reach out. There are a lot of, tax professionals out there, and they're all very, very good, but make sure you jive with them and they understand your business as a specialist. My clients are real estate professionals, real estate owners, real estate salespeople. This is what we specialize in at SRG Advisors. So I want to make sure that I'm offering the best possible tax advice to that industry. And that's the industry I'm specializing in, where we have most of our clients. So it's not like I'm going to get a call one day from someone, outside of that world, and I don't know what I'm talking about. This is what we do on a day-to-day basis. We're full year tax CPA. When someone asks me what I do, I tell them I'm a tax consultant, because yes, we do preparation of tax returns, but that is just a side piece of what we truly do, which is consulting, making sure the clients are getting the proper advice that they need.
Fantastic. Hey, man, I've got your tax tracker information up there again.
Perfect.
I want to remind everybody that we are again back next week. Again, of course, why wouldn't we be? And we're going to have the great Amy Ransdell, who is a leading expert in peak performance. She is a badass. There is no question about in coaching and peak performance and doing things differently. And she's also the broker owner of Powerhouse Real Estate in Georgia. She's out of the Atlanta area. Looking forward to have Amy on with us next week. Jay, there's only one more thing I got to do. I want to thank you for coming on. And I know the thing that really pushed you to do this was you heard that everybody gets a hat that comes on the broadcast. So here it is. It's coming out to you. And when you get it, of course, you're going to post it and show everybody that you got the hat and everything else. I want to thank you so much for coming on. Please stay on for another couple of minutes as we come back. We're going to let everybody go. Don't forget, next week, guys, we are going to be here at Real Estate Talk TGIF. It's going to be episode 240 next week. We're really excited about that. Thanks again for coming on. Jay, I'll be right with you.